Welcome, everyone, to the PPM Attorney Capital Forum. I'm your host, Darren Mangum, Securities Attorney, Managing Partner of Mangum & Associates. And we are excited today. This is our 14th forum session. Welcome, everyone. We're going to talk about debt securities today, which may seem kind of dry or boring, but debt securities does come in handy in a variety of situations where you're not wanting to offer the investor an ownership interest or an equity interest in your business, but you fully expect to pay the investor back. In fact, a lot of our clients, especially ones that are doing real estate, they're more comfortable with the debt securities offering. Typically, they're using a lender, whether it's a hard money lender or some kind of investor for individual projects. And so the nice thing is it could really, debt securities could be really issued for really any sort of venture, any sort of company. Obviously, it's a very, very different type of security, and so we'll go through that. But yeah, welcome everyone. I am just making some notes here as far as that goes, but if I give you a pen there, I have a pen. Thank you. Just making some notes of some questions that I've got coming in for people. And we'll cover the questions at the end. And if there's any topic or if there's any subject related to debt securities offerings that you didn't get covered here on the session today, please feel free to email those at the end of the session to just forum@mangumlaw.net, and we'll get those addressed. Or if there's any other topics, broadly speaking, that we have that you'd like to see covered. This is our 14th session that we've covered a variety of topics. I think I'll go through some of those now. We've talked about just a broad overview of the securities markets, different considerations to raising capital, different deal terms, different types of investors, what's all in a PPM, using brokers, finders. There's a variety of topics that we've already, public offerings, private offerings, all of which are available to forum members as recorded sessions, and this one is going to be recorded as well. So feel free to dive into any of that content. But if we haven't covered anything that you're seeing out there, let us know, and we'll be glad to either address it on a forum session or answer it directly. So anyway, debt securities, what are we talking about? Really, when we're talking about any sort of obligation to repay, the money has to be repaid. Now, the features of debt, meaning that typically there's a principal amount, and then there's interest. Typically, there's always interest, and there's terms, right? So examples of debt securities are, the most common one is like a promissory note. Promissory notes are used in a variety of business contexts, especially when it comes to real estate, and you have different types of debt. You've got notes, notes, bonds, debentures, any sort of evidence of indebtedness, right? Meaning that it's going to go on the books of the company. And it's important to make sure that we're not talking about consumer debt here. We're not talking about a personal loan. Although sometimes that is a factor because if you've ever borrowed money from a bank in a typical setting, usually the bank is going to ask for what? They're going to ask for a personal guarantee, right, of the borrower, right? Which, maybe you're borrowing it for a business venture, right? But they also they typically ask for a personal guarantee or a pledge of your personal assets, right? If you ever done like an SBA loan, SBA loans are just, really, really commonly promoted out there. Hey, get an SBA loan, like it's no big deal. The problem with that is that the problem with SBA loans, or really any sort of debt like that from an institution, they're 99% of the time they're going to require collateral, and they're going to require a personal guarantee, right? So what happens if the business fails, right? The whole idea around drafting up a PPM to protect yourself, right? It doesn't do you a whole lot of good if you've drafted up a PPM to protect yourself, but then, oh, by the way, the business doesn't work out, and maybe the debt still has to be repaid, and guess what? They're coming after you personally, right? If you had sold them a share of stock, or you sold them a limited partnership interest, and say the venture or the partnership didn't turn out, well, you would, that's just how businesses, some businesses fail, some succeed, this is how it goes, right? You're not going to have to reach into your pocket. You're not going to have to pay your house, sell your house to pay those investors back, right? In a corporate debt setting, it's the same way, right? When the company is obligated to repay the loan or the partnership or the venture, whatever it is, whatever legal structure you put into place, and the business is responsible to repay the investment. Now, the advantage of doing it through a PPM is that, while you fully intend to repay the loan when the company is successful, it does not typically also, we would always strongly discourage a client from taking on a personal guarantee, right, when they're issuing debt securities, right? Obviously, the investor, if they're asking for a personal guarantee, right, then you're typically going to be dealing with what we would call like a venture capitalist or a vulture capitalist. Some people call them that, or like a hard money lender, right? They're always like tying you up with a personal guarantee, in addition to. So it's not only an obligation on the books of the company, but it's also an obligation on your personal. You're personally liable, personally on the hook to repay this money, right? That's not what we're talking about here. We're talking about the company issuing a corporate note, a corporate bond, and there's, the investor is taking on that risk that the company is going to be able to repay their investment, right? And so, in any event, if you're issuing securities like these, then you definitely want to have good legal counsel drafting up the instrument, or the instrument being the promissory note, or if it's a bond, and what are the differences, right? I mean, you hear these terms: a promissory note, a debenture, a bond. They're all different forms of debt. Usually, notes, a promissory note. Usually those are shorter term type loans where you're doing 1 or 2, maybe 3 or 4 year notes. I mean, you could do those longer terms. Whether their payments are required, or whether it all accrues at the end of the term. All these are various deal terms that go into the promissory note. A bond is much the same way. I mean, a bond is usually, it's a debt instrument. It accrues interest, And typically bonds are a little longer term in time, and typically bonds are also secured by company assets. And that's a key feature of any sort of debt. Is it secured or unsecured? What does that mean? Well, is unsecured debt means that, look, it's really not tied to any sort of collateral at all, right? It's just an IOU. It's just a promissory, like a promissory note. You can have secured promissory notes. You can have convertible, promissory notes, like a convertible note. That's where the investor or the company, either way, has the option to convert the debt into equity in the business or the venture under some circumstances, like in case of default, or in case of maybe the company goes public, or maybe they just have an option, right? Hey, I'd rather, instead of you paying my money back, I'd rather convert over into equity, right? These are all very different features that could be structured inside a debt type offering, right? A debenture, same thing. It's just it's a debt that has to be repaid. You hear about convertible debentures, convertible notes. They're all they go by a lot of different names, but at the end of the day, it's a debt, right? It has to be repaid, and really the key question becomes, okay, what's the interest rate going to be? Does it have a coupon? Are there monthly payments that are going to be required? Quarterly payments? Interest only, principal and interest? All these factors would come into play when you're structuring these types of instruments, right? As far as secured, investors typically like to see some kind of security, right? Like, I'm gonna, if you're not able to repay the debt, maybe it's tied to some specific asset that I can then attach as collateral in order to try to recoup my investment. Interest rates play into this as well, right? Like currently, as we're recording this today, interest rates are pretty high. You're seeing, I think the federal, I think the Fed's around 6 to 7% interest rate. I haven't checked it in the past few days, but it's up there. And so when you look at corporate debt, because it may be, obviously there's a little more risk involved because maybe it's a new venture, maybe there's maybe it's unsecured by any assets. So typically, that interest rate is not, you're going to be maybe have a hard time selling investors on a 6% interest rate when inflation's at 6%, right? And that's always going to be in flux, right? And so when you're looking at structuring these securities, you have to always certainly look at the prevailing interest rate environment, right? So, we've got an outline here that we're going down. But as far as the different, from the issuer's perspective, or from most of the members of the forum are entrepreneurs raising capital for their company, and your company is typically referred to as an issuer. What are the from the issuer's perspective, we can talk about the pros and cons of debt, right? Number one, I don't have to give up any ownership, right? I'm not giving up any long-term equity, right? I'm using the money, doing what I need to do, and I'm able to pay it back in the future, right? And give that investor their interest, or principal and interest, at some point, right? Obviously that's a big advantage, because I'm able to use the money, I'm able to get my company off the ground, and then I just repay it at some future date, right? I'm using time as leverage to, obviously I'm paying some interest, but at the end of the day, I still own 100% of the company, or I haven't given up any of my equity in my company or my venture to an investor, right? They repaid the loan. Once the loan is repaid, investors are done, right? They're gone, right? Obviously some of the considerations of that is that it does have to be repaid, right? That's and the due date never typically arrives at a convenient time. And so, you may think, oh, I'm going to be able to repay this investment a year or two out, and then let's say the company doesn't, it takes a little longer to get it up off the ground or whatever it happens to be. Well, that debt is going to be will come due, and so there's factors that you need to figure into the instrument or the like if it's a promissory note. You want to make sure that you have the ability to extend the note if needed, or maybe the interest rate fluctuates if interest rates change. There's lots of ways that these instruments can be drafted, both to your advantage and maybe to the investor's advantage, right? Certainly as an issuer, usually as a securities lawyer, we're typically drafting these things for clients to their advantage, from the company's or the issuer's advantage. And so those are things that need to be considered, right? So as far as but yeah, obviously the investor, but you still have to structure the debt instrument in a way that is attractive to the investor, right? And we talked briefly about interest rate environment. What is the interest rate environment? What are the other things that the investors could possibly invest in, put their capital to work in, and that could generate a similar type return, right? Or especially given maybe the risk of your particular venture, maybe the investor could put their money into something a little safer with a comparable interest rate. Well, you have to definitely price the securities. Usually, you'll see companies, private issuers, issuing like debt securities at a higher interest rate than maybe the investor could get by just putting their money in a money market, right? Like a money market, you see banks right now offering like around 4% to park their money at their bank, right? Which up until the Silicon Valley Bank failure earlier this year was kind of unheard of. Banks were only offering like half of 1%. There was not really a big incentive, but now banks have said, okay, well, we can part with 4%. If the federal rate's 6%, we're offering you 4%. Let's say inflation's at 6%. We're offering you 4%. I don't know. It's still not a smart place for most, from an investor standpoint. That's like still kind of like they're barely keeping their money. They're barely keeping their money at work. It's inflation is sort of eating away at that investment. So they're looking for what? They're looking for higher yield, right? They're looking for higher yield. They're looking, but also they're looking for safety, right? It's a balance. And so when they come to the private equity markets or the private capital markets, and most all PPMs fall into that category as the alternative investment capital markets, where these companies or ventures are offering a lot higher interest rate on debt securities than an investor would typically get either in the market or or at a bank, right? So yeah, you want to structure the offering in a way that appeals to those investors. You're trying to convey to them security or safety. Hey, you can invest in our company with reasonable assurance that we can pay you back, and also we're going to be paying you back your interest rate at a very attractive interest rate. Now you can possibly, you definitely want to structure the investment in a way that doesn't hurt the company either, right? You can promise a super high interest rate, but is that going to maybe hamstring you down the road when the company is operational and you're cash flowing, but you still have all this debt that you promised the you promised the investor a high interest rate, that was great at the time you actually got the money, but down the road it may prove to be difficult to repay that in a timely fashion, right? And so you have to balance that from both your perspective as the issuer and also that of the investor, right? It's a balance, right? And so as far as structuring them from a legal standpoint, well, we can talk about that in a second. Let's talk about what. I've got Bob here has a question on when, and we can go ahead and address that now. When would be a smart time to issue a promissory note offering? And again, I don't know. Bob doesn't really say what kind of business is it. Let's say it's a real estate offering, right? If it's a development type project where you have in other words, the project is not cash flowing. Well, let's say it's any kind of business. Let's say it's a business that is developing a healthcare supplement, right? And maybe it's going to take, you're forecasting, maybe it takes maybe a month, maybe about 6 to 12 months to develop that supplement. Well, so it would make sense for me to. It would not be advisable to really issue a debt instrument or a debt security that had a monthly coupon. Like, I've got to make monthly payments on this because why? The company is not cash flowing, right? You could do it. You could set aside a large interest reserve in order to pay that interest, but because the business is not cash flowing, that's just less capital that can be put to work to grow the business, right? It's just sitting there to pay interest, right? It's better to, if you are going to do a debt offering under that circumstance, it's better to it'd be better to issue like a balloon note at the end of the term, right? But even in that case, having forecasting out, okay, a year from now, 2 years from now, we're going to repay you this note. It can be a little tricky because maybe your timeline of when you're going to be cash flowing may be in flux, right? You're not exactly sure when you're going to be able to start repaying this, right? I always advise clients. You can certainly do it under any circumstances, but I would always suggest that companies steer clear of debt offerings unless they have a very clear path to revenue, right? If you've got a very clear path to revenue, hey, this project's going to be up and running within 6 months, 12 months, and we're going to have immediate tenants. We've already got tenants coming in to lease these properties, or we already have a purchase order for this product, so we're just using this as a short-term gap. You can. I always recommend you only use a debt security as if you have a clear path to revenue with a reasonable chance that you're going to be able to repay that debt right within that relatively short-term time frame. Now that doesn't mean that you can't go out with a longer time horizon. Different projects have different time horizons, and so you just have to certainly just make sure that you're running some hypotheticals and making sure that those timelines are pretty reasonable from your standpoint. So those are all various factors that come into play when you're trying to structure these sort of investments, right? And so David here is asking, when would I issue a convertible debenture? a convertible debenture is really just the same, a fancy word for a convertible note. A convertible note, a convertible debenture, meaning, hey, it's a debt instrument that has to be repaid along with principal and interest, but there's some factor where, hey, if we go public, or if we sell the company or something like that, then at that point the investor converts the debt into equity, right, in the company, right? It really gives the investor some upside. Convertible notes are really a great vehicle if they're structured properly to give the investor not only a reasonable rate of interest, but also some potential upside, right, in case the company is successful. Because the company is wildly successful, like if let's say Facebook had issued some promissory notes at like 10% interest to launch their company, and later they wind up going public for like 1,000 times their original value, right? You would have, as an investor, you would have been much better off insisting upon some sort of convertible note. Instead of, oh, here's a promissory note. Okay, great. We just hit a home run, but here's your principal and your interest back. Thank you, Mr. Investor, for playing. Have a nice life, right? That investor would have probably been better off having some kind of convertible feature in the note, right? Now, when you're pricing these things, you gotta, that comes into play. If I'm giving you from the company standpoint, it's like, hey, if I'm giving you an obligation to repay you, right, or I'm incurring an obligation to repay you, and then also giving you some potential upside as well, then okay, maybe I'm going to be less generous on the interest rate side, or maybe it's maybe the repayment terms are going to be a little more flexible, right? Because why? Because I've given you this conversion feature that may convert into, maybe it converts into 10% of my company, right? Or maybe some revenue interest or something like that, right? So. Again, the nice thing about debt securities is they can be really they can really be structured in a lot of different ways to really fit the needs of the company or the issuer, and also at the same time appeal to the investor, right, that wants that ability to be repaid. If investors are more interested in the long game or the long run, okay, well then maybe. Maybe they need to look at an equity investment, or like I said, like a convertible equity type situation where they've got some ability on the upside. So those are some examples of some this is a general overview of different kinds of debt securities. Obviously, devil's in the details. Definitely have a securities attorney structure the debt instrument for you. If the investor is structuring the investment deal terms, then you definitely need to have counsel checking that out for you. But in most cases, most of our clients we're the ones that are issuing the securities or issuing the promissory notes. And so we're the ones that are dictating those terms, right? And you're obviously pricing it in a way that's to the most advantage of the company, while also at the same time appealing to the investor, based on prevailing interest rates and market conditions, right? So what are some examples of debt instruments, right, or debt offerings, right? We did an offering, probably it's been like 10 years ago. We did an oil and gas bond offering, right, where the company was needing additional capital to further develop an oil and gas field that they had developed, and they but they didn't have a current project. The only thing that they really had to leverage was their existing revenue stream from producing oil and gas wells, right? So they issued a bond saying, hey, look, we're going to give you a security interest in these wells, and in order to, obviously it's secured by the assets of the oil production, current and future oil production, and obviously the oil and gas in place. That was the collateral, and they issued, I think it was like 5-year bonds based upon some, they're offering, I think, like 10 to 12% interest, and this was back 10 years ago when interest rates were practically zero, right? So that was a very, very attractive investment, and it gave the company operating capital to go and secure other options or other properties nearby that they wanted to later drill, but they weren't quite prepared to structure an equity investment around, right? So that's just an example, right, of how that works. Other examples, real estate being what it is. I mean, we've done lots of real estate related. It's not really hard money terms, but it was, I think 10%. I think it was like 10 to 12% interest on real estate. Giving the investors a secured interest in the real estate, but it was subordinated, right? It was subordinated because there was also a bank involved. And so I think the capital stack was like, they had some equity investors in there, and then they had the bank in there for a balance, and then they came up with, I think it was like $10 million of secured notes, basically in second position on the property, right? So these investors were had a security interest in the property, obviously subordinated to the bank, but at the same time they were ahead of the equity investors, right? So that's how that played out. So anyway, there's lots of ways to structure a debt offering. Sometimes, so anyway, at the end of the day, you need to, sit down with your counsel and your financial advisor and say, okay, hey, let's game out what this may look like under different circumstances. I always recommend doing hey, here's kind of what we expect, and then also here's a better case and a worst case scenario, and hey, how would the securities offering, or how would these deal terms play out under either one of those circumstances, and that'll really help you answer, hey, should we issue a debt offering or not, right? Or maybe it may, depending on the timing of your venture, it may make sense at certain times and maybe not so much in other times. Anyway, so there's a lot obviously to analyze on a particular deal, but I appreciate the questions that people have asked. We do want to make a quick note as we wrap up here of our capital, our preferred capital source, Marquee Equity. Marquee Equity is they're based out of India. They've got over 30,000 investor profiles that they've accumulated, ranging from accredited investors to angel investors, family offices, institutional investors, different types of investor groups. And so we're offering a free introduction to any member of the Capital Forum, the PPM Attorney Capital Forum. So if you'd like us to set up an introduction to talk to them, we're glad to do so. And anyway, that's all the time we have for today. But I appreciate everybody watching. And again, if there's any questions that you have that we haven't been able to address on the call today, again, feel free to email those in. And obviously, if you're coming in late or you missed this session, it's going to be recorded and it'll be up on the platform within a couple days. So anyway, thank you for watching, and we'll see you next time.